Today's topic is average rates, and are we going to have a housing crash? Now, we've all seen the headlines in the press this week about the property market, from mortgage rates being at their highest and how some papers have even called this the perfect storm. Believe it or not, this headline last hit the papers on the 23rd of September, just after the mini budget, when we were all told the property market was going to crash. That was almost 10 months ago. Now, with any headline, we really need to take it with a pinch of salt, but we also need to consider the wider aspects of what is happening. Let's take mortgage rates. Now, they're currently a hot topic, even being discussed in the House of Commons, and Michael Gove is meeting with the big banks tomorrow to discuss the current mortgage climate. Now, the mortgage rate that's been thrown around is average rates of 6.01%. Now, whilst this might be true, say, at 95% loan to value, the more deposit or the more equity you have does change this dramatically. If we look at rates as of this morning, a 2-year fixed at 90% starts at 5.23%. A 5-year fixed starts at 4.98%. If we then move to 75% loan to value, a 2-year fixed starts at 5.07% and a 5-year fixed starts at 4.64%. Not quite the 6.01% headline that's been branded about. But what is interesting is the rates that we're seeing today are like those that when the economy was booming back in 2006, 2007, and these mortgage rates were seen as the norm. Now, are we going to have a housing crash? In simple terms, I think the answer is no. And here are my 4 reasons why I don't think we're going to have a property crash. As discussed last week, we've got above average wage growth. According to recent data, homeowners now have record levels of equity in their property due to exceptional house growth, thus allowing them to secure some of the best deals that are open to them. Most banks now offer mortgage terms longer than the standard 25 years, some even offering mortgage terms of 40 years. Again, giving homeowners more options when it comes to budgeting. Finally, let's not forget people like stability, which is why fixed rate products are in huge demand, as these allow people to budget while also planning for the future. And one more point actually, it's probably the biggest one. In 2008, the banks pretty much closed their doors to all lending. They didn't have the money to lend. The banks thankfully learned from these mistakes and they now must hold enough funds in reserve. In simple terms, they're still lending money. They've not had to close the shop like they did back in 2008. It's also worth noting that when you apply for a mortgage now, banks perform a stress test for this very situation, ensuring that when rates do rise, your mortgage will still be affordable in the future. Now, those on variable tracker products should consider their options sooner rather than later. And if you're at all unsure, then I would strongly advise you to speak with a mortgage broker. They will provide you with all of your options and help you navigate these challenging times. Those looking to buy or move this year, again, should speak with a mortgage broker. Not only will they help you find the best deal, but most brokers have a great understanding of the local market and will be able to guide you when it comes to submitting an offer, thus allowing you to put forward an offer that will be attractive to a seller, but you'll also be safe in the knowledge you have a mortgage that is affordable today and in the future. And if you're keen and you want to understand what mortgage rates are doing, or you're considering moving or even buying your first home this year, then you should book a free consultation using the link below and let one of our expert mortgage and protection advisors guide you through the journey. See you all next week.